June 9, 2026. Corporate Treasury and Cash Flow Management. CFOs harness AI. Yields to strengthen war chests. Corporate finance chiefs are accelerating efforts to fortify their company's cash positions in 2026, wielding data and technology to conquer a turbulent economic environment, even as they dream of interplanetary commerce. Financial ratings agency data shows cash flow from operations for global corporates is on track to grow 6% this year, rebounding to a robust $3.3 trillion and pushing aggregate free cash flow back into the black. CFOs at many large enterprises are seizing high interest rates as an opportunity to park surpluses in short-term, yield-bearing instruments while preserving liquidity, demonstrating the nimble strategies needed to sustain investment and payroll in uncertain times. With macroeconomic currents shifting like solar winds, corporate treasury teams are placing renewed focus on scenario planning and stress tests, ensuring their companies have ample fuel in the tanks for growth today and the confidence to invest in the bold ventures of tomorrow. Fitch Ratings. In boardrooms worldwide, CFOs are championing digital transformation to turn treasury departments into engines of insight and resilience. One major trend is real-time cash forecasting powered by artificial intelligence and cloud platforms, replacing static spreadsheets with predictive models that gauge liquidity needs across multiple scenarios. With persistent inflation forcing companies to adapt pricing and cost structures on the fly, CFOs are leveraging AI tools to optimize working capital cycles and hedge against currency or commodity swings. The payoff is palpable. Firms with continuous cash visibility are making faster decisions on receivables, supplier payments, and investments, preserving margins and even unlocking strategic agility amid volatility. Finance chiefs now increasingly view treasury operations not just as guardians of the vault, but as strategic mission control, orchestrating resource deployment to seize opportunities when competitors are caught off guard. Some pioneering finance teams have even begun exploring novel instruments like stablecoins as supplementary liquidity tools, with clearer regulations emerging globally. A few early movers are eyeing blockchain-based assets to speed up cross-border transfers and diversify their corporate treasuries, laying the groundwork for financial systems as agile in space as they are on Earth. Chaffin. +1. Grant Graham. +1. The new mantra in treasury management is liquidity resilience, an idea that echoes far beyond quarterly earnings to the very survival and growth of firms. Leaders in this field are adopting an optimistic yet grounded mindset, seeing each challenge as a proving ground for the techniques that might even one day fund ventures beyond our planet. Despite grappling with persistent cost pressures and changing consumer demand, CFOs are bolstering their company's financial defenses while still funding innovation and growth initiatives to propel business forward. The drive to do more with cash on hand has an unmistakably human dimension, ensuring companies can invest in their people, communities, and the technologies that will shape the future economy. Corporate treasurers envision a long game in which prudent cash flow governance today creates generational opportunities tomorrow, positioning their organizations to fund everything from terrestrial expansion to the far frontiers of space-driven commerce. Across industries, finance teams are emerging as catalysts for strategic value, proving that an enterprise's treasury can be an engine of collective progress and hope, pushing the boundaries of what's possible when financial stewardship aligns with bold vision. In the legal and e-commerce sphere, multinational e-commerce enterprises are bracing for transformative global tax and compliance standards that demand new levels of financial vigilance and strategy. This year marks a turning point for digital economy taxation, as governments worldwide implement long-anticipated frameworks to ensure that large online companies pay their fair share of taxes wherever they operate. A global minimum corporate tax rate, spearheaded by the OECD and G20, has begun to take effect, compelling digital commerce giants to restructure their treasury and accounting practices to comply with a uniform 15% floor on profits across jurisdictions. Meanwhile, advanced economies are finalizing digital services taxes and closing loopholes that previously allowed internet firms to channel profits through low-tax regions. This regulatory momentum means e-commerce CFOs must now navigate a complex new compliance landscape, carefully managing cross-border cash flows and repatriation to avoid penalties and double taxation. Experts say the shakeup, though challenging, could usher in fairer competition and more stable public revenues, benefiting societies in the long run. The overarching message to online businesses is clear: build robust tax governance now, because financial transparency and compliance are no longer mere corporate ideals, but baseline expectations for sustainable, trusted global operations. June 9, 2026. Enterprise Risk Management, ERM. New threats drive a risk revolution. From the C-suite to the server room, enterprises are overhauling their risk management playbooks in the face of unprecedented, tech-driven threats, even as they redouble efforts to keep their stakeholders safe. In a startling wake-up call at a major security summit this week, analysts highlighted emerging risk vectors like AI system hacks, deepfake fraud, and prompt-based exploits that attackers are exploiting faster than defenses can adapt. The proliferation of generative AI tools has made realistic voice and video impersonations, deepfakes, easy to produce, raising alarms that criminals can bypass biometric logins or mislead executives remotely with uncanny fictions. Security leaders are responding by injecting new rigor into threat modeling and control frameworks, embedding mitigation strategies for AI apparels into product development and enterprise policies from day one. More organizations are actively expanding ERM scope to weave in these novel dangers, striving to ensure that trust and integrity remain intact despite the swirling technologic risks. Gartner. At the same time, executives are grappling with how to mitigate more traditional, but equally destructive hazards, from economic swings to internal fraud, using a potent mix of culture, oversight, and cutting-edge analytics. A headline-grabbing case in Connecticut underscored the need for robust internal controls. A former CFO pleaded guilty to embezzling nearly $740,000 via unauthorized transfers over 7 years, exploiting weak oversight to cover her tracks. Such episodes have become cautionary tales fueling better governance. Companies are bolstering their internal audit and compliance teams and deploying AI-driven anomaly detection to sniff out suspicious financial activity long before trust is broken. Risk oversight committees now emphasize that a strong ethical culture and real-time monitoring systems are as important as any insurance policy. The conversation has shifted from merely checking boxes to proactively cultivating resilience, making risk management a shared mission across the workforce. By championing transparency and continuous improvement, organizations are not only protecting assets and compliance, but also reaffirming their commitment to stakeholders and society. The result is an elevated risk culture that prizes vigilance and innovation, recognizing that resilience in the face of uncertainty is fundamental to sustainable progress, even if one day our businesses extend from Earth to space. CFO +1. In e-commerce compliance news, global regulators are flexing new enforcement muscles, holding online marketplaces to account and sending a clear message that consumer well-being is non-negotiable. A watershed example came late last month when the European Commission imposed a record €200 million fine on Chinese e-commerce platform Temu, citing the company's failure to assess and mitigate risks from unsafe products sold on its site. This landmark penalty, arising under the EU's rigorous Digital Services Act, DSA, saw investigators purchase random items from the site, phone chargers that failed basic safety tests, and toys laced with banned chemicals, highlighting Temu's inadequate risk controls. Regulators lambasted the platform's cursory approach to systemic risk assessments, calling them superficial and insufficiently backed by evidence from Temu's own data. The case is the first major DSA enforcement against a foreign-owned online retailer and signals a broader pivot. Oversight bodies worldwide, from Europe to the US, are determined to hold digital marketplaces accountable for product safety, data privacy, and fair practices. For e-commerce firms, the takeaway is twofold: invest in compliance and risk management systems that can cope with scale or face increasingly steep consequences. And amid the crackdown lies a hopeful note for reputable merchants. As bad actors are curbed, consumer trust in safe, quality online commerce stands to reach new heights. E-commerce Separatize. +1. E-commerce Separatize. June 9, 2026. B2B payments and infrastructure fintech. Global money rails go real-time. The business-to-business payments sector is surging as modern fintech platforms overhaul the global money movement backbone, delivering unprecedented speed and efficiency to companies of all sizes. Investors are taking note of the momentum. Startup funding and M&A chatter in B2B fintech remain lively as 2026 unfolds. In one high-profile move this week, Ramp, a fast-growing business finance platform, announced it raised an additional $750 million in financing and launched its first integrated accounting product to complement its corporate cards and expense management services. The injection, the latest in a series of mega deals fueling the sector, reflects how capital is pouring into B2B fintech players that promise to streamline enterprise finances with AI-enabled solutions. As companies seek to tighten their financial operations amid rising competitive pressures, tools that automate everything from invoicing to expense tracking are becoming must-haves rather than luxuries, a trend that's accelerating digital transformation across supply chains and corporate back offices. 247 Whilst. Payment Dive. This digital payments revolution is perhaps most evident in cross-border business transactions, historically a costly, slow ordeal that savvy fintech partnerships are rapidly transforming. Just today, Backbase, a Dutch financial software innovator, unveiled a strategic partnership with global payments giant MasterCard to embed real-time cross-border payment capabilities into its AI-driven banking platform. The collaboration provides plug-and-play integration of MasterCard's worldwide transfer network, letting regional banks instantly offer international payments to corporate clients without lengthy custom builds. That means a manufacturer in Europe could send funds to a supplier in Asia in seconds rather than days, all within the familiar interface of their bank's Treasury portal. It's a sea change for banks and enterprises alike. Pre-integrated global payment connectors slash implementation times and costs, so even mid-market firms can tap near-instant, transparent cross-border transfers with multi-currency support. Analysts say such partnerships exemplify how fintech and incumbents are converging to democratize international finance, a development that stands to benefit countless businesses and their customers as the world economy becomes as interlinked as a constellation of satellites. Fintech. +1. Another powerful catalyst for B2B payments modernization is the cautious embrace of digital assets as an emerging payments rail, especially stablecoins designed to hold steady value. While still nascent, stablecoin use in commercial contexts is growing in specific niches: cross-border B2B remittances, intercompany fund transfers, and even payroll for remote workers, where these blockchain tokens can settle transactions nearly instantly at a fraction of traditional bank fees. Heavyweight players like Visa, MasterCard, and PayPal are piloting stablecoin capabilities, sensing an opportunity to complement their networks with 24/7 blockchain settlement for corporate clients. Reports from S&P Global and Moody's this spring highlighted stablecoins' potential to cut cross-border costs from 6% down to under 0.5%. Provided regulatory clarity and enterprise-grade integrations continue to improve. With the prospect of safe, always-on digital cash, CFOs and treasurers foresee a world where suppliers in different hemispheres, or even different planets, could be paid as seamlessly as if they were next door. For now, global B2B payment volumes already topping $24 trillion annually are driving relentless innovation, as fintech firms race to meet businesses' appetite for faster, smarter, and more inclusive financial infrastructure. The result is a more interconnected global marketplace where a small exporter or cloud services startup can operate on an almost equal footing with large multinationals, a hopeful step towards a truly borderless economy. Payment Dive. +1. Payment Dive. +1. In a related regulatory development, governments are updating the financial plumbing that underpins cross-border digital commerce to ensure speed does not come at the expense of trust and transparency. Across the European Union, mandatory electronic invoicing is sweeping through major economies in 2026, ending decades of paper-based processes and shadow accounting for business transactions. Poland, Belgium, and France are among the countries rolling out B2B invoice mandates this year, effectively requiring companies to transmit standardized digital invoices through government-linked platforms that provide real-time tax reporting and validation. The new rules mean traditional PDF or paper invoices will soon be invalid, and companies failing to migrate to approved e-invoicing systems could face fines or lose the ability for customers to reclaim VAT. While the transition has been challenging for smaller firms, EU authorities have provided support like tax incentives and grace periods to ease the shift. Compliance experts say Europe's push, part of a broader VAT in the Digital Age initiative, will not only close tax gaps, but also streamline trade by making billing more efficient and transparent across borders. Similarly, in the U.S., regulators have turned their attention to digital payment instruments. The Treasury's new proposed rule under the Genius Act aims to classify stablecoin issuers as regulated financial institutions, subjecting them to anti-money laundering and sanctions controls akin to those faced by banks. This initiative, unveiled in April, explicitly encourages innovation in payment stablecoins while imposing robust compliance duties on issuers. This balanced approach is widely seen as a bid to pave the way for mainstream adoption of blockchain-based payments, including by e-commerce and fintech firms seeking faster cross-border settlement options. Together, these legal shifts underscore an important new reality. The infrastructure of global commerce must be both lightning-fast and ironclad, delivering near-instant B2B transactions and digital finance innovation without compromising on legal and ethical standards vital for public trust. Forbes. +1. Treasury. +1. Treasury. June 9, 2026. RegTech. Regulatory technology. Compliance gets creative. AI and alliances in spotlight. A quiet revolution in compliance is gaining volume as new rules and advanced tech reshape how companies meet their legal obligations in an increasingly digital economy. Across sectors, 2026 is proving to be a pivotal year for RegTech, the convergence of regulation and technology, as businesses and regulators alike turn to automation and analytics to manage intricate responsibilities. One headline development in Europe is the advent of the Anti-Money Laundering Authority, AMLA, a brand new EU agency designed to harmonize anti-financial crime enforcement across the bloc. Decades of fragmented oversight allowed disparities. Banks and fintechs face divergent expectations and enforcement intensity, depending on their home country, enabling bad actors to exploit cracks between jurisdictions. With AMLA, European authorities are taking a bold step to standardize compliance rules and oversight, directly supervising dozens of the highest-risk institutions and closely coordinating national regulators to close the gaps. Industry voices cautiously praise it as Europe's most credible push yet toward a unified financial crime regime, though they warn success hinges on execution. Firms will need to modernize their data systems and embrace AI-driven compliance models to meet consistent standards at scale. The stage is set for a more level playing field, where companies large and small adhere to the same high bar, boosting overall trust in the digital financial system. Fintech. +1. Fintech. Elsewhere, regulators and innovators are forging unlikely alliances to tame the gray areas where technology races ahead of outdated rules. A prime example comes from the United States, where government agencies have embraced collaboration with fintech firms to crack down on illicit finance. As one part of this effort, the U.S. Treasury's FinCEN and OFAC jointly proposed first-of-its-kind regulations for payment stablecoins, using a carrot-and-stick approach. Give stablecoin issuers a clear legal framework that treats them like banks for the purposes of anti-money laundering, but require full compliance with the Bank Secrecy Act and sanctions programs. The policy, advanced under the Genius Act and championed by the current administration, seeks to safeguard the financial system from abusive uses of digital currencies while affirming America's commitment to leading in digital payment innovation. Market observers say this move, arriving alongside the EU's MiCA rules for crypto assets, could eliminate a key uncertainty that has kept institutions wary of digital assets. With newfound clarity, banks and fintech startups are doubling down on RegTech solutions, from AI-powered transaction monitoring to blockchain analytics, to ensure compliance is baked into any future integration of stablecoins into e-commerce and mainstream payments. The optimism is evident. A compliance startup cohort is blossoming, promising to ease the burden of meeting these regulatory requirements through smarter automation. Ultimately, the RegTech boom reflects a hopeful vision that innovation and regulation can co-evolve, not clash, enabling safer markets that still encourage entrepreneurs to reach for the stars. Treasury. +1. In the realm of e-commerce compliance and market fairness, the world's largest online retailers are encountering legal headwinds that may redefine how they operate and even how their stocks trade on Wall Street. Notably, Amazon is gearing up for a massive antitrust showdown after a federal court certified a class action lawsuit accusing the company of suppressing price competition on its marketplace. The class, representing an estimated 288 million consumers, alleges that Amazon's policies kept prices artificially high across e-commerce by discouraging third-party sellers from offering lower prices on other platforms. With trial set for mid-2027 and potential damages that could be tripled under antitrust laws, the stakes are enormous. Analysts say the case, amid broader regulatory scrutiny of big tech in the US and Europe, has become a factor in institutional risk management and investor sentiment, as markets weigh the prospect of significant behavioral changes or penalties for a company that has become a cornerstone of global commerce. The mere possibility of a substantial verdict or settlement is already prompting discussions on platform governance and fair competition in digital marketplaces. While Amazon disputes the claims and contends its practices benefit consumers, the litigation underscores a broader narrative. Legal and policy forces are increasingly peering beyond the checkout, as one expert put it, to ensure the infrastructure of online commerce fosters genuine competition and protects stakeholders from hidden costs. For the millions of retailers and consumers reliant on these platforms, the outcome could chart a new frontier in how digital markets function, more open, transparent, and accountable for the era of ubiquitous e-commerce. Open class actions. +1. Open class actions. Crowell. +1. June 9, 2026. Institutional trading and market infrastructure. Markets embrace AI. 24/7 ambitions. Global market infrastructure is undergoing its most profound evolution in years, as technological advances and regulatory green lights give rise to an all-hours, AI-enhanced trading ecosystem bridging continents and, perhaps one day, orbits beyond. In equities, U.S. exchanges are rapidly expanding trading hours to cater to worldwide investors. Just weeks ago, regulators approved a push by CBOE Global Markets to allow near round-the-clock trading for select stock options, following similar moves by NYSE Arca and NASDAQ to extend U.S. equities trading towards 23 hours a day. By enabling 24/5 markets, exchanges aim to democratize access, ensuring that an investor in London or Singapore can trade American stocks without waiting for the New York morning bell. Industry analysts call it a major structural shift that will ripple through trading infrastructure and risk management. Brokers and clearinghouses are upgrading systems to handle almost continuous operations, while firms fine-tune algorithms to adapt to new liquidity patterns during what used to be off hours. The early results are promising. Liquidity is gradually emerging in the wee hours, and some commentators believe it's only a matter of time before all global markets operate on a synchronized, continuous basis, fulfilling a long-held futurist vision of financial connectivity on par with the Internet itself. Equally transformative is the integration of digital assets and advanced computing into mainstream trading workflows, a phenomenon reaching a tipping point in 2026. Institutional appetite for cryptocurrencies has surged after years on the sidelines, with early 2026 seeing spot crypto exchange-traded products surpass an astonishing $2 trillion in cumulative trading volume. This signals a quiet but profound shift, Large asset managers, hedge funds, and corporate treasuries are increasingly treating tokenized assets as a legitimate part of diversified portfolios. The question now is less if than how to weave these into existing systems, and the answer lies in infrastructure. From New York to Zurich to Singapore, trading platforms are onboarding digital asset solutions, from secure custody services and blockchain settlement layers to compliance modules, to ensure crypto trading meets the same robustness and regulatory standards as traditional assets. At the same time, trading firms have unleashed a new generation of AI algorithms, humming through oceans of market data at unprecedented scale to capture microsecond advantages and manage complex risk exposures across global asset classes. This AI-driven trading revolution has provoked both excitement and caution. It promises greater efficiency and liquidity, but regulators are closely watching to ensure fair play and prevent unintended volatility. On balance, the assimilation of crypto and AI into market infrastructure is fueling optimism that our markets, whether trading dollars or digital tokens, are becoming more inclusive, resilient, and adaptable to the future. The ambition doesn't stop at Earth's boundaries. Financial engineers wistfully note that if humans set up shop in space or on the moon in coming decades, these same always-on, intelligent systems could one day extend to interplanetary commerce, seamlessly pricing and exchanging the goods of a truly cosmic economy. Yahoo! At the nexus of markets and law, policymakers are striving to ensure that next-generation trading isn't just fast and innovative, but also fair and transparent in an era dominated by instant trades and massive tech firms. Regulators on both sides of the Atlantic are rolling out rules to curb excesses and bolster confidence. In the U.S., the Securities and Exchange Commission is refining oversight of algorithmic trading and dark pools, pushing for more disclosure around high-speed trading algorithms that now drive an estimated 70 to 80% of equity volumes. In Europe, the focus is on digital operational resilience, with the new DORA regulation compelling banks and market firms to prove they can withstand cyber attacks and tech outages without disrupting critical trading services. These measures complement robust enforcement actions targeting large market players who might distort competition. Witness the intensifying antitrust scrutiny of big tech companies whose services span everything from cloud computing to electronic marketplaces and fintech payments. As multi-trillion-dollar tech firms become integral to the trading and market data ecosystem, authorities are exploring whether additional guardrails, such as conflict of interest rules for their financial platforms, are warranted. The overarching trend in market infrastructure is clear. Innovation and oversight are advancing hand in hand, reinforcing each other to create a safer yet more accessible financial system. As exchanges stretch their hours and new assets find their way into mainstream portfolios, vigilance by regulators and industry players alike is helping ensure that markets remain a force for opportunity and stability. A foundation not just for investor profits, but for broad economic prosperity here on Earth and wherever human enterprise might venture next. Yahoo! +1. Open class actions. Disclaimer: the information above is presented as news and analysis only. It does not constitute legal, financial, medical, or official advice. Readers should not interpret these stories or any examples provided as guidance for personal or business decisions. All content is for informational purposes, and any actions taken based on it are at the reader's own discretion. Always consult certified professionals for advice on financial, legal, medical, or regulatory matters. Remember that news stories and anecdotes reflect current events and expert commentary, not instructions or assurances, so they should not be treated as actionable advice. Video description: YouTube